What's up, everybody? Michael Silva here. Hope you're all having a wonderful week. I'm not. Not only sick, but man, holy cow, I have been having a hard time firing off some intraday trades. It's been a rough start to the week. And I want to start by saying that just because I'm going to be sharing with you one of my next big trade ideas. I'm going to walk you through why I think it's going to play out. And I also want to disclaim that, hey, I'm wrong all the time. Like so far for the start of this month, right now, I'm not doing all too hot. I did great in April, but now I'm not doing too hot. It's all about managing risk, getting through it, right? We're going to have winners, we're going to have losers, but you got to understand the risk factor of all of this. But I'm going to walk you through my thought process on this next big trade idea. And then I'm going to walk you through just what I think is going to happen in the market in the near term, given some of the stuff and indicators that I'm looking at. So we're going to start right into it, okay? Let's take a look here. This right here is a squiggly line. The squiggly line represents a couple of things. There's two colors on the squiggly lines. The sine curve is an orange one, and that is representing the stock market cycle. And up top, you'll see something interesting. You'll see names, right? Those names are representing sectors in the stock market. And what it's telling us is as we get towards the top of the market, well, it tells you what sectors typically do better. And when it starts to turn, you see what sectors are typically doing better at that time the market's turning. Actually, leading up to 2022 and early 2022, we noticed that the top performing sectors were actually consumer staples, utilities, and healthcare. And that was one of the indications that we kept on hammering in, saying, hey, things might be coming to an end here very soon. Okay, so that's that part. Now, the blue is the business cycle, okay? And you can see the stock market cycle leads the business cycle. Go figure, right? We know this stuff. Now, I want to point out something. You have technology, consumer communication services, and consumer discretionary sectors right here. And that's typically right at about this time, which lines up with what? It lines up with this blue line that's pointing down the business cycle where we go into a full-blown recession. And this is where they typically start performing better. It doesn't mean that necessarily they're going up and away, or that they've hit a bottom already, that we've hit a stock market bottom. But I just want to point out this. This is year-to-date performance in the 11 sectors that make up the S&P 500. And what you see here from a year-to-date perspective is discretionary, communication services, and you have technology stocks leading the charge so far. This doesn't mean, once again, that they can't come down, but what I want to call out is we have these performing the best. We've already seen a market turn down, so are we nearing the time where we see a potential stock market bottom? And as you all know, there's a lot of macro factors out there that are telling us, leading us to believe that we could be very well heading into a recession. I want to look more into the business cycle aspect of it. So that's that blue line right here. So what happens when we start moving down? If you take a look at the sine curve, when we start moving down, you'll notice that typically stocks and commodities go down. And as we've been seeing, commodities such as oil has been getting crushed. And that right there is a huge, huge sign. It's telling us that, hey, oil right now could be very well sniffing out a recession just around the corner. Okay, now stocks go down, commodities go down. What typically goes up? Well, that's the trade idea. It's bonds. Okay, this is, I believe, stage one. We're in the early innings of stage one, potentially still even in stage 6, where bonds could potentially still go down, but we'd still be heading very soon into that contractionary period. So we're either at the tail, just the end of this, or the potential beginning already of stage 1. Now, this is an interesting aspect of it. We have to understand what the Fed is going to do and what the market perceives the Fed is going to do to why we can potentially see bonds as a good opportunity. Okay, as it stands right now, they just raised another 25 basis points. Okay, so our current target rate is at 500 to 525. Okay, now the next meeting is in June. In June, there's a 90% probability that we are going to stay at 5 basis points, or 5% to 5.25. Okay, so basically what that means is we're pausing. That's what the market is perceiving. And we know that the Fed has said that their base case is to hold rates higher for longer. Okay, we know that. However, What is the market sniffing out? Because after the more hawkish press conference of the Fed, look at what took place today in the meeting probabilities. If you take a look, right, we just talked about June, there's a 90% probability we're going to stay right there. But then in July, it's pricing in a potential rate cut. And it's not a small amount. That's a 60% probability now, but that's not even it. There's also a 5% probability of a 50 basis point rate cut. So that's, 66% or so, 60% or so that they see that the Fed is going to start reducing rates. Now, my question is this, and then it just drops off like a cliff every single month. My question is this: what's going to force the Fed's hand to reduce rates? And it could very well be what we're seeing out there in the banking sector, right? We're seeing regionals, banks, they took another big hit. Could be potential capitulation. And the Fed may have to step in to do something. Now, that is completely speculative and a complete narrative. Now, if I take a look at bonds, we'll use TLT as the proxy here. There's other avenues, right? There's a whole host of different bonds you can get involved in. I'm just going to show you TLT. Now, TLT, we've been in this stage 4 decline for quite some time, right? It's just been downhill, right? All the moving averages are flowing downstream, right? Down a river. Up until recently, we had this nice big thrust up. That big thrust up has been holding itself together rather nicely so far, right? Going sideways. And that's bringing all the moving averages here together. This, to me, potentially is giving us an early indication that we're in a stage 1 accumulation, okay? And it's offering up a potential good risk to reward. Where are we now? Well, we're about 105. So if we say, okay, the bonds, we believe that they're going to be going up into a markup phase, well, you got to understand, okay, well, what happens if the Fed does start cutting rates, or where would my risk factor be? Like, so for example, if I were entering in, and I've been trading these like pretty frequently, the bond volatility is still rather high, which I didn't even think to bring in a chart of the move index. I should have, but bond volatility is high. Maybe it's already peaked and now it's going to be coming off, which would be positive. Perhaps you'd have a stop under here, right? Or a stop under here. Or if you're a longer term investor, you may be like, I'll give it some room and then I'll just build into a position. And if it comes down, cool. Or I'll wait until it breaks out over here at around 110-ish area. Okay. Now, what happens if the Fed cuts rates? Or actually, before we even get into that, I'll show you an interesting chart here and then I'll layer on the bonds to it. Okay. So what do we have? We have the S&P 500 up top. We have the 10-year and 2-year curve, right? The 10-year and 2-year yield curve, which, by the way, look at, it's starting to curl itself back up right now as it stands right now. So we're at minus 38 basis points. And that's important to know if it comes out of uninversion. The 10-year and 3-month, however, is still, very deep inversion. It's 189 basis points, which is, the majority of us have never seen this in our personal lifetime. It dates back to the early 80s, okay? Now, if we go back over to this chart, we have the 10-year and 2-year curve. It's starting to curl itself back up. Doesn't mean that necessarily it's going to get uninverted right away. But what happens if it does get uninverted? Okay, well, let's take a look here. Well, we've seen actually times where the market breaks and we get nasty sell side, right? This was a great financial crisis, 58%. This was 51%. That was a dot-com bust. And I just marked the levels here. What would a 50% drop look like? I'm not saying that that's going to happen, but what would it look like? Well, that would look like S&P 500 down to 2,500. Well, would it even look even steeper if we just matched these highs? Well, that'd be a 67%. That'd be gigantic. That would be a crisis for sure, okay? Now, if you take a look here, what I also found interesting on this chart is while they uninvert, what do you notice taking place in the Fed funds rate? Well, you actually see them, it uninverts, and you see them start to take rates down, right? It uninverts, rates go down. So something breaks, and you see this flush to the downside. So the market right now is saying, hey, we see the Fed's going to start reducing rates. That's not what Powell's saying, and Powell's been holding tough so far, all right? So this is, like I said, just speculative, obviously, but I'm just trying to, potentially lay out scenarios of what could happen. Okay, so they're saying that it's going to start cutting. And if that's actually the case here, let me fix that. If that's actually the case, okay, does that mean the S&P 500 potentially drops further? Well, it's possible. We've seen that in history. So if they hold rates here, but then all of a sudden start crushing into 2024, well, I mean, history tells us that that's not always good for the stock market, especially when you just look at a couple other times that we had these financial crises. Now, what happens to bonds during that time? Well, let's layer on this chart. It's the same chart, but I squeezed in TLT over here. Now, now it's TLT, it's been around since here, so it can't go really farther back, but you can kind of see that when the rates started cutting here, well, if you just look to the right, well, bonds actually started taking back up, okay? And then right over here, you can see that, okay, what happened? We had the yield curve uninvert, Fed started lowering rates, go down even further. What was going on with bonds? Holy macaronis. Boom. You saw a huge rip in bonds while they started lowering those rates, okay? So what am I looking at now? If we start uninverting here, if we see actually something starts to break and then they start lowering rates, this could be the early stages of potentially a larger move in bonds. And that's just looking really at this chart. Now, I'll also show you, look at 2020, right? I didn't even mention 2020, right? The where we slammed rates basically down to zero, right? We had this little inversion, right? If you remember, a little tiny inversion over here right before the COVID pandemic. And then it started uninverting, right? And then the Fed started lowering rates. Well, what was bonds doing then? Boom. As soon as we went to the zero interest rate, boom, right? Boom. A huge, huge move in the bond market. So if the Fed funds probability, the Fed funds futures is correct in assuming that the Fed will start reducing rates here, I think TLT is going to be an excellent play. You can look into other things like IEF, BNDD. There's a whole host of different bond products, but that could be something to pay attention to. All right? Now, moving on. These are the, now, that's where that was the process. I can just make that a video in and of itself. But now it's time to get into the more of the daily stock market brief stuff. And this is where you get a good glimpse into, okay, what can we expect just going into really tomorrow and the next day? Well, here are the expected moves for tomorrow. If you want to screenshot this is something that I share with my Discord group. I'll go over that a little bit. But if you look at the daily expected move, these are the expected moves, plus or minus, for these products over here. And, I like to focus on the S&P 500. The SPY has a $4.20 move. Haha, 420. And then you can see here the upper level and the lower level. Now, why are these important to know? Well, I'll give you an example. So for today, the S&P 500 was falling down like a rock, probably pretty scary. Maybe people wanted to start shortening down there and FOMO into stuffs. But I had mentioned in the Discord group that the downside, where am I looking? Downside may be limited, but obviously don't think it's not possible for more red, okay? And playing bounces, you have to be aggressive because of the overall context of the chart. Why did I say that? Well, it was because we were already reaching down into that daily expected move, which we talked on yesterday's brief, and we filled that gap from the other day, which can act as a level of support. And you can see we came into it, we bounced, right? Boom, we came right back down to it. It just kind of doodled around there all day. So going into tomorrow, what do we need to pay attention to? Well, the expected move, once again, it's large. It is big. And I'm looking at this, I'm like, wow, potentially come down to 400. That'd be pretty gnarly move. And you could look at this and be like, well, it's a bear flag. I mean, it's possible, right? Boom, boom, it breaks right down. Okay. But we got to pay attention to every other kind of, sector and asset class within the S&P 500, because actually, in my opinion, what I'm seeing here is setting up for a potential bounce. Now, am I willing to put everything I have on it? No, but you got to be at least aware of it, and I'll give you the reasons why. So first, I want to call out that we're below the 5-day moving average. It's starting to decline. We're below week-to-date, month-to-date moving average, and we're below the anchored VWAP, the JWAP, Jerome weighted average price from the Fed announcement. Okay, so first and foremost, bearish context, okay? That is bearish. So playing bounces, you need to be aggressive, you need to be tactical, and you got to be careful. Okay, now, couple of things. Well, we had the positive divergence right here. We had a positive divergence a little bit earlier. It's starting to play out. Okay, that's positive. The PMO is starting to curl up. Okay, that's just a couple of technical indicators that are, lagging. But here we go. Apple after hours reported earnings. It's up 2%. Okay, and Apple is the largest market cap stock in the S&P 500, and it holds a lot of weight. So if Apple's going to hold up tomorrow or potentially go higher, that could be good for obviously the S&P 500. But that's not it. Take a look at crude oil. Crude oil has been getting slammed, okay? But today in light sweet crude oil futures, you can see this large tail, right? So we came all the way down to 64 and we ripped right back up. This is a potential bottoming tail. You can actually see something very similar here. Now, why would that be important? Well, because the energy sector actually in the top 15 names, top 12 names of the S&P 500, you have some energy names in there now because of how good they did in prior years. And you can see here, the last 3 days got absolutely slammed. Even today, it was down 1%. And if I just drew a little trend line here, right, it's acted as a level of support. So we bounce from this, we bounce from this, we bounce from it, bounce from it, and now we're coming right back down into it. Now, that doesn't necessarily mean that it has to bounce, but after this aggressive move, you got to ask yourself, would you short there or would you look to cover if you were short and then potentially re-short on green, right? That would be my base case scenario. So if we do start bouncing here, that can also help obviously the S&P 500. Okay. That's all I got for you on today's episode, everybody. I will go over the zones really quick. The last kind of aspect of all of this is we also have the VIX that fired off. The upside in the zones is rather limited versus the downside, and the SPX is obviously the upside. Sorry, the downside in the S&P 500 is more limited versus the upside. So now we have a green, range here for the S&P, red for the VIX, and we've talked about this multiple times, right? Where things get a little bit too heated. I'll also note that gold and silver, they have been on a rocket ship. So if you were in some of the miners that we shared in the trade ideas, update your risk parameters, right? You do not want those winners to turn into losers. And you obviously see a lot of other aspects here that are green, meaning that if you just pay attention to this indicator right here, the low, the midpoint, and the high, when the assets over here start reaching to the lower end, meaning that they've been selling off quite a bit, they start lighting up green on this side. So it's important to just know, okay, what's lighting up red, what's lighting up green, and where does it stand overall? Now, if you like the zones, I share not only this page with the Patreon group, I share a bunch of different other stuff too. I do currencies, I do China equities, I do the miners right now, I do fixed income. I do just a whole host of stuff. The S&P 100, the entire S&P 100, and so forth. I also do, if you like the expected moves, I do those daily. I do monthly, quarterly expected moves, weekly expected moves as well. And if you like some of the indicator charts that I use, I post them on the stock market indicators. And then obviously you get access to the community as well. I do that all. It's $9 a month. There's no strings attached. It's just $9. If you want to do it annually and save, you can do for 16% off, and it's like $90 US, and you get access for the entire year. Make sure that you want to do it because I don't do refunds for the annuals or even the $9, right? I'm not asking for a lot of money for the amount of work that I put into this. I wanted to create a good big community of individual traders and offer much more than what else you see out there. The trade ideas, I should just tell you, it's not about me giving you the answers, right? I don't sit there and I tell you go in, go out, go in, go out, go in, go out. I give setups and things that I'm seeing, and I give ideas out there, okay? So if that's not what you want, if you want somebody to just tell you what to do and you never want to get better, this is just not the place for you. That's all I got for you, everybody. See you later.